started a bunch of companies, most of which failed. Partech became an investor in two of them, and after I sold them, I came around the table and joined the team. So now I'm on the investor side, seeing things from the other side, if you wish, but still trying to remember what it was like on your side. So we are a early stage investment firm with roots in San Francisco, Paris, and also Berlin now. We try to find the best companies wherever they are between those two continents. And we have two vehicles. We have a seed stage vehicle where we invest a few $100K in companies that are still kind of searching for their business model. And we have a venture fund where we invest up to 10, 12 million in a company over whatever stage it makes sense. That's in a nutshell.
So, yes, my name is Carlos Diaz. I'm still in the bright side. Not for, I don't know for how long.
You mean you have a real job?
Yeah. No, I'm an entrepreneur. I started my career as an entrepreneur in France in '96. I basically only did that. I mean, I created my first company. I was 23. Before I was working for national education in France, so that was not really a job. So I started my first company in '96. It was the really beginning of the internet in France. It was a web agency. We discovered it was a web agency after 5-6 years. At the beginning we didn't know really what it was. But I managed this company for 11 years, and we sold this agency to Imakina, that is a large digital communication group based in Brussels, that is listed in Euronext. And then after, I created a software company named Blue Kiwi Software. With the first company, we haven't raised any money. We did all that, by ourselves. We created a company in Limoges, in central France, and we were not, entrepreneurs. We didn't know anything about technology or whatever, so it was really, it was supposed to be a failure, and it wasn't. That was very interesting. With the second one, we decided to raise money. We raised money with Sophie Nova in France, and maybe we raised too much money, by the way. If I look at the money I got back, at the end, I think if I had to do that again, I would have raised, less. That's something maybe we can talk about, also. But we've been successful with Blue Kiwi. We became, a European leader in enterprise social software, social business software like Jive, maybe these companies here in US. And we sold the company in 2012 to Atos in Europe. And I moved here in 2010 with Blue Kiwi to expand the business here in US. And when I sold the company in 2012, I was like, what do I do? Do I go back to France to enjoy my money? It was not really a good time, François Hollande was arriving. So I decided to stay here in US and start a new startup. It's like a dream for a French entrepreneur, of course, to start a startup here. It's like playing the Champions League. That's what I used to say. It's been, when you're a French player, playing the League One, and you've got an occasion to play in the Champions League, you're very happy. Now, what you need to understand is that the Champions League is not easier than the League One. So don't come here believing that it's going to be easier. In fact, it's going to be harder, here, because you're playing the Champions League. So here I am, with my new company, Quarter. And what we're doing with Quarter is we're trying to make sports on TV more interactive and create mobile application to interact with the game you're watching on TV. And this week is very important because it's the World Cup, the FIFA World Cup. So we've got a lot of projects running all over the world, in Asia, Europe, US, and South America with different partners. And we're launching a new product named Wager League that allows you to bet, virtual betting, around sports, on your mobile. So this is what I'm doing.
Sounds exciting. Fun.
And if you're a developer and you're looking for a job, please contact me now.
My name is Glenn McRae. I'm with Early Growth Financial Services. We're an outsourced finance firm. What that means is if it doesn't have anything to do with the basic technology of your business, the sale of your business, the operations of your business, we can probably help you with it. We have high-level CFOs, people like me. I have over 20 years of experience being a chief financial officer as well as being a chief operating officer. When you're the finance person of a small company, you better do more than just finance because there's not really enough finance to keep you busy full time. So that means that we're used to solving problems. And I don't have the depth of experience in fundraising that these gentlemen do from the negotiating standpoint, but I see a lot of the other aspects of what goes into raising capital. So we have about 400 clients. We do.
I'm one of them. We use your service.
Are you a happy client?
Yeah, beautiful. I had to use your service, by the way, because the investors asking to make a valuation, a 409A valuation.
And that is beautiful. I supervise the valuation side of the firm. That's one of my areas of responsibility, as well as the tax side. So if any people here have any specific questions around taxes, and it's not part of this, because I know U.S. taxes can be very complicated and very confusing and not make a lot of sense.
We had a workshop on this last week.
Okay. Well, I'm sure all your questions were answered there.
No.
And we are French, so we know about complexity and taxes.
Yeah, well, we can commiserate then.
For part of our DNA.
Right. And so, anyways, the other part of my responsibility, I'm a partner with the firm, and I used to have a portfolio of clients where I would advise and help, and we do their monthly financials for them, provide financial reports to the investors, those sorts of things. But now I'm full-time on the management side, and one of the things I do is I introduce our clients when they're trying to raise capital to VCs who might be interested in looking at them as potential investments. So we've got about 180 relationships in the venture capital community, and my job is to build those relationships so that I understand the kind of companies they're looking to invest in, and when our clients are at that stage, I can make the appropriate introductions via email. So it's not an investment banking service, it's a matching service. So I do have some perspective on the investment raising process. In my prior life, I was in the securities industry. I was a CFO, COO for an investment firm, and we had investment banking as part of what we did. And so I understand the mechanics of investment banking here in the United States. And then when I left that firm, I raised $6 million for a startup of my own that was ultimately not successful. But I have experience going out and asking for money as well. So I'm kind of here to fill the gaps in what Nicolas and Carlos can answer from a specific experience perspective.
Okay, thank you very much. So I know a lot of people raised some questions, so we can do this workshop more as a conversation at some point. We can, afin Nicolas could start taking us through the term sheet. Please, Glenn, feel free to jump in, and Carlos, share your experience as well, whenever you feel it's pertinent. And then we can take questions. Just raise your hand. We can take it from there.
Yeah, please, let's make it interactive, because we had a informal exchange about how to talk about this notion, these issues around raising venture capital and negotiating terms, and as part of that discussion, I thought, well, there's a document that's been kind of fine-tuned over the last 30, 40 years in Silicon Valley that captures really most of the key concepts that are part of this discussion. And I'm often surprised, if not shocked, by the lack of knowledge by some entrepreneurs who are not from Silicon Valley. I'm not singling out the French by any chance, by any means. It's the same thing with people coming from Oklahoma City or Germany. Yeah. But it's actually really important to understand those basic terms and why they're there. Right? And they tend to be very, very quick discussions when we deal with local entrepreneurs. Discussions focus really around the core business aspects of the term, whereas every time we deal with people who are outside of this area, it tends to become a very emotional set of subjects, because when you start talking about preferences and vesting and board and all that stuff. So anyway, I thought that it might make sense, and I printed out what is kind of a template. It's actually the Partech template.
Terms a good one,
right? No, I mean it really captures some of the key terms, and then obviously everything gets customized every time. But those terms need to be understood, right? And they also change depending on context and stage. So this is a typical Series A, So as of 2 months ago, I apologize. 2 months ago, my vision finally gave up. So the way this is printed, I need
It's very small.
anyway, so a lot of these terms are, intertwined, right? So typically, you can never look at valuation really without considering the stock option pool or without considering the liquidation mechanism. Right? So let's put valuation aside for a second because
This may be the most emotional, by the way, point, but sometimes not the most important. Depending
very
on
often
the other
not the
terms.
most important, right?
Yeah.
And that's a very good point. And just the only point I'll make here is you need to understand, that it's when it says fully diluted basis, that means that's after everything is done, meaning including the stock option pool more specifically. Right? We'll get back to that. So the pool, let's talk about that. Because that's the first thing that tends to shock people who are not from Silicon Valley. By definition, you're a small company, you're going to have to hire some key people, and that's one of the reasons why you're raising money. Those people need to be associated to the success. There's an expectation that you're going to give them stock options. All of what I'm saying sounds trivial, but practically speaking, that means you need to reserve a meaningful piece of the equity for these people. The standard in Silicon Valley, so it will be customized every time, right? But depending on how big and how well formed your team is already. But the standard in Silicon Valley is at Series A stage. Standard used to be 20%. It's been relaxed in some cases, but let's say it's 10 to 20% is the range of stock option pool that will be built in. Let's say 15 is probably the average on the Series A in the term sheet, which means that if you raise $5 million at $10 million fully diluted, just taking round numbers, with a 15% pool, that means the effective valuation of your business is 3.5 million. The 1.5, the 15% come inside the 10. You guys are clear on that?
Repeat that.
So, okay.
Maybe you have a question regarding the stock option. You are talking about
Please, interrupt anytime.
an American company with stock option.
Yeah.
The American company. How do you deal with stock option with a French company?
Not much different. Right? It's, in fact, it used to be more of an issue because of the option valuation mechanisms that we used to enjoy in Silicon Valley. Right? So in the past, you could grant stock options, and you're the pro at that, right? At a very, very low exercise price, right? Like 1/20th or 1/15th of the price of the preferred. You can't do that anymore. You have to grant them at fair market value based on the famous 409A valuation, which actually isn't much different than the price at which you can grant options in Europe these days, right? So it used to be a real issue for hiring. You had to be able to really grant stock on a US company because it was much more attractive to employees. That's not an issue anymore. But the logic is the same for us. By the way, not for all European VCs. We often have the problem that we work or compete against other VCs in Europe because we try to implement the American kind of term sheet terms in Europe, and that there's not that many firms that do that. But in the Valley, since we're talking here about Silicon Valley and how business is done here, there's an expectation that you're going to hire people and compensate them with stock options in a competitive way. And Carlos, we were just talking about how competitive this Valley is. So the way this gets determined is you have to be, we typically want to see, the VC wants to know that within the time frame of the funding, let's say over the next 18 months, 24, depending on how the funding is constructed, you have enough stock in the pool to compensate and hire the people you need to hire within the plan. So this is kind of how it's built up, right?
Yeah, and that's a very important point that, for example, myself, didn't get, really quick enough. I mean, that's when I moved here, to US. When we are French entrepreneurs, most of the time in France, I used to define the CEO in France as a chief excrement officer, meaning that the vision of the CEO in France is a guy that will do everything, himself. So he's on the product side, he's on the business side, he's the one who makes all the sales, he's the one who recruits everybody. Basically, he's the one who manages all the shit together. So that's why I call him, the chief experiment officer. When I moved here and when I created my first company, I was a chief experiment officer myself. I was trying to basically do everything. One thing I understood here as a CEO is that this is not the business, this is not the job of a CEO. And you're right. You better negotiate with your investors a pretty large option pool, because the reality is that you really need to recruit people and get them on board and make the maximum of what we're supposed to be your job that is not your job. And as a CEO, I think that the job of a CEO is 5 things. The first thing is, first of all, of course, to get the vision and communicate the vision and explain everybody where we're going and why we're going there, what the mission statement of the company, etc., etc. The second thing is really to recruit people. That's really your job. It's really to be around, try to meet with the best hands you can and try to bring them, in the company. And that's a very important job as a CEO of the company. That should be your job. You should not externalize, this kind of thing to others, or if you do so, you should manage and control this process, because most of the people, and because it's very competitive outside, they're going to join your company because of vision and because they want to work with you. And the third thing you have to do is really to push your team. Pushing your team on a daily basis, saying, hey, this is important, what we're doing here, and why this is important, and not do the stuff in yourself, but really push your team and be a pusher, every day, sit next to your team, try to understand what they're working on, and saying to them and explaining them, that it's important and stuff like that. The fourth thing is really to communicate, outside, is to really to be one of the guys that explain, why the company is successful, what we're doing, what is the growth of the company, and try to communicate outside the maximum you can. And the fifth thing is to find money, because that's really your job, to really find money and have a relationship with investors, try to get the best deals, the best terms, etc., to provide the fuel that you need to continue, the endeavor of your company. This fifth thing, if you think a little bit of that, that's a full-time job. And if you do all these 5 things, you don't have time, to develop, to code, to make sales, to blah, blah, blah. So you need to find people to do that. And the people, you need to find, you need the best guys, of course, because they are very important stuff, to do. And you will attract these people not only with money, but also with options and shares in your company. And I think that, for example, the 10 first employees should maybe have, in average, 1% to 2%, of the company, because they are key people. And that's very important. And that's not the way we do, in France. Usually we believe that we can do everything ourselves, and we just need employees.
But by the way, those 5 things I would agree with, and particularly I think I agree with the order in which you rank them.
So at what point do you think in the equity raise that the option pool needs to be refreshed with additional options? So this 15% you're talking about reserving is at Series A.
There's no religion on that, right? So typically we like to be rational about it. So it's not, I'm not saying 15% arbitrarily. We try to build with the entrepreneur bottoms up plan, right? So who do you think you need to hire? How much do you think these employees need to be compensated? And keeping in mind, and I kind of agree with Carlos's kind of numbers, keep in mind that a VP, a decent caliber VP in a startup, almost doesn't matter what function, is going to be, will want to be 1 to 2% at the Series B stage, right? Which means that Series A, it's, a key person, hiring somebody in a key role who you think is going to scale with the company and hope we're going to scale, and giving him less than 2% is tough, right? Because they know they're sophisticated, they're going to be diluted again. And the following round, when you bring somebody else in, you're not going to give them more than the guy who came early, right? So you have to think ahead of that. So I think it's built bottoms up. So first part of the question, the answer. Second part is it gets reevaluated every round.
What numbers do you usually see when you give a postdoc to VPs that are hired?
Well, it all depends. I mean, it's all usually a percentage, so you can't really say arbitrarily number of options because it's all relative, right?
Okay.
Depending on how many fully diluted shares there are out there. Some companies have 1 million fully diluted shares. Some companies have 40 million fully diluted shares. But I think what Nicolas is saying is a good rule of thumb, which is senior folks, and Carlos echoed this as well, 1 to 2% is very typical.
I remember a board where I was saying, to my board members here in US, oh, that's pretty cool. Look at that. We haven't given a lot of our option pool. And I thought it was pretty good news because we negotiate. And they look at me and say, this is very bad news. I was pretty proud of that. Like, I didn't give a lot of the shares, the company. Look at that. And I said, no, this is bad news. You should give, the share of the company because that means that people that you're recruiting right now, they're not invested in the company enough. They will leave the company. And you know what? That's exactly what happened.
And that's a great point. When we see a company where one guy has 80% of the ownership, it's a red flag.
Yeah.
And there's also many issues, and we could talk for a long time about stock options and how employees look at them and how they're treated, because there's a number of different issues. Investing is a key concept.
So we're going to get to that.
Exactly.
Yeah, we have a lot of CEOs, so maybe we should go to founder shares.
Oh my God.
So let's talk about quickly generic vesting, right? There's a standard in Silicon Valley. It's accepted. It's been practiced forever. It's 4 years. Every employee who gets hired gets typically 4 years of vesting of their shares and a 1 year cliff, meaning that if you leave or get terminated within a year, you don't have any stock, right? So it's actually really important as a founder to think about it, because when you hire a key executive and you feel like you're giving this person 2% and oh my God, what if he doesn't work out? Well, you really aren't taking any risk, because
Absolutely.
if they don't work out, it's
You
really
fire
not
them.
costing you anything, right? And you're going to know within a year.
But one thing we need to explain also, because that's pretty strange, and weird for French guys, you can fire people here in US. For French people, it's pretty strange. Really? You can fire people? Yes. If someone is not making the job, you know what? You can fire him. And that's not a problem. And by the way, I had a conversation with...
It can be a problem. Maybe it contradicts you.
Well, but you can have a conversation with him, and saying, okay, you know what, it's nothing personal, but it's just a business, etc. I had the employee saying to me, oh, thank you.
So now let's talk about the founder share, because that's always a very emotional topic, but a really important one. And it's funny because we hardly ever have that discussion with Silicon Valley entrepreneurs, really, and I mean it. There is typically, when we invest at the early stage as a venture capitalist, we want the entrepreneurs to be committed to building the company. The last thing we want to do is run the company. We don't know how. We're investing in you because you know how, right? I mean, you know your business and you want to do it better than anyone. That's the belief that drives our investment, right? So we want to make sure that you're going to be in for a while and committed to this. So that's really the rationale behind putting in founder vesting. And founder vesting typically means that, look, you're really just beginning to build this company. Doesn't matter what valuation we put on the company today, whether it's 4 million or 20 million, it's really just a bargaining kind of mechanism at this point. Right? You haven't really established the value of the company, and most of all, you're not doing this to build a company that's worth $10 million. You're doing this because you want to build something big. Otherwise, you wouldn't be talking to the VC. Or you shouldn't. So the way these interests get aligned is by saying, hey, Carlos, I know I'm going to invest in your company. I know you've been working on this for a couple of years to set it up, but I know we're going to take your ownership in the company and grant you maybe 25% of that today, and the rest to be vesting over 4 years, typically monthly, right? What does that mean? it doesn't mean actually, and that's where the emotional discussion comes in. So the reaction of the French entrepreneur is,
"You're taking my
"He's
shares."
taking my shares away."
Yeah.
I am absolutely taking nothing, right? I don't want to take your shares away. Okay, I'm just trying to align our interests, right? But it does mean that if, after 6 months, Carlos decides, you know what, San Francisco is really nice, I'm going to go surfing instead of going to the office. And at some point, well, it's not going
I'm
to
a good
work
surfer,
out.
and I'm a good surfer.
Right. So
You have to recognize that.
at some point, the board's going to say, you're a nice guy, but we're going to have to do something about this. So if he's no longer, or he just decides to leave the company, then at that point, he will lose whatever portion of shares, he has invested, right? That's what this means, right? But it tends to be a very
Why?
emotional.
Because you have also to find another CEO that you have to compensate, with something.
Right.
And the shares, you will take away from me. It's not for you. It's going to be used, maybe for a new CEO or whatever,
Yeah,
is
so,
needed.
so I know some European investors have term sheets where they actually give that ownership to the investors.
That's
That's
wrong.
not the practice in Silicon Valley, just to be sure. It goes back to the company overall, right? We lose everybody and it's reused for future grants of whoever you need to hire. But it's a really, really important concept, and if you the discussion might be around how, is it 25%, is it 30%, is it whatever, depending on how much you've done. But you should expect to have that.
The cliff is the same as for.
No, there's no cliff typically. Typically, there's no cliff because he's already in there. He's been working. I mean, there's an assumption of good faith, right? Otherwise, we wouldn't be investing, right? If I didn't think, he's going to bust his ass to make the company succeed, right? That's really the underlying. But I was shocked when I recently had I don't see you guys react much, so I'm hoping that means you think it's obvious and you agree. But I was recently talking to a group of the HEC entrepreneur. I think you met them too.
They were good, by the way.
Great. And I was shocked that even some of the professors who teach venture capital at HEC in France were kind of surprised by this stuff.
I know. I would say that it's
Shocked.
because it's also a very cultural thing. I think that in France we have a very bourgeois culture where we own stuff. We like to own stuff, and we are in a very bourgeois, vision of stuff. So it's my company, it's my shares, and stuff like that. So you're gonna steal, a little bit like it's very French, And when here it's very entrepreneurial. It's about doing something together. And of course, this is about people. This is not about we didn't put any money. It's not just about an idea. Everybody can have an idea. It's about executing this idea correctly, and recruit the right people to execute this idea. Of course. So if you think this way, then this is really about driving the car. This is not about buying a car. So I think it's a very important point. When that happened to me, first time, I was shocked, because that's not something that I was used to when I was in France. We don't have these kind of terms, in termship. So I was shocked first. I was like, no way, never. Fuck you. Really, go fuck yourself. I would never give you anything, of my company. It's my company, etc., etc. And then, I met, with very smart, investors that try to explain me that, and I was wrong. It's I think that the way Nicolas explained that very well. By the way, that's really the way we should think. It's really about you. We're investing in you. We believe in you. But if you're not here anymore, so what are we investing in? The company doesn't exist yet. You're building this company. If it's not you, we have to be someone else, and we have to compensate, this guy. So yes, of course, you mentioned something very important, is that if you were running this company for a few years, you can ask for maybe 25% of your shares, already vested, because that's what I asked for, because I put my money in the company. I said, I put some of my money, I put some of my time in the company, so I should have part of these shares, already vested based on what we've done so far. And it wasn't a problem. Yeah, of course. and we got, I got 25% of the shares already vested. What do you see? Yep.
You know, in France, you have similar thing. It's not exactly technically the same term, but the VC they have the right to buy the founder share at a certain valuation, which is very low. So if the founder leaves the company, the end result will be
Yeah,
the
but
same.
you see that goes back to the investors.
Yeah,
It's a little different, right?
Yeah.
And we actually have that in some of our deals in Europe,
Like rent
not necessarily put in by us, but maybe by other investors.
Well, and I've got a story to share.
Yeah.
So I have a client where they invested, the VC invested as a seed stage as a convertible debt. And I know we're not going to get off track and talk about convertible debt, but they did put a significant enough amount of money to be able to put these kind of terms in place with the founders. There were two co-founders. One of the co-founders left the company, and those shares reverted to the other founder. And this investor is upset. He's saying, hey, I had two guys that I invested in. Now there's only one. I will no longer do a convertible debt where those shares are not vested and reverting back to the company. So he's, he got burned. So just a case in point.
Yeah, I mean, keep in mind that the absolute last thing an investor wants to do is terminate you as an entrepreneur. Right? That's like the worst news for us.
Depending investor.
Just trying to align the interests.
No, I mean, that means we made a bad decision.
No, it's not your case. I know Partech, you're not these kind of guys, but there is investors around that are not like you. And there is investors that it's kind of a game, for them. They take company, they remove the CEO, they put another one, because they want to go IPO. They want a guy that already did an IPO before, and they push, the funders, out. It's kind of they always do that. And if you look at their track record and their portfolio, they did that for 70% of that. So when you choose an investor, really make your own due diligence on the investor. It's not only them, doing due diligence on your company. It's really you need to make your own due diligence, because I'm not saying that these investors are wrong, because some of them are very successful, by the way, but you need to know how do they manage, their companies, what their style, what their culture, and you need to be sure that this culture fits with your culture, because it's not that there is one that are good and other one are bad, that's not the case, but they have different policies. And you need to fit, with this culture and these policies. That's not the case. Don't do that. You can be with the most beautiful girl, in a relationship with the most beautiful girl of the world. But if you cannot stand, to spend, hours, with her, your life will be a nightmare. You know what I mean? If you don't like the same food, if you don't have, no, it's going to be very French now. I'm going to stay. You get the point. Yeah, you get the point. So your life can be. So you've got a very beautiful girl, next to you, but your life is a nightmare, and that's sometimes the case. You get very beautiful investors next to you, very beautiful names, but your life is just a nightmare. So choose your investor correctly.
Your VC's portfolio before raising money.
Call CEOs.
Call the CEOs.
Call the CEOs.
Oh, yeah, absolutely.
Call the CEOs and ask them what happened.
What was it like?
Yeah. What was life, with these guys?
And you had some CEOs tell you to not go with his VCs, or
no, usually that's not what they say, but they explain you what were the life, and then you figure out, you understand. And so I think that there is like a trust, a lot of trust in between entrepreneurs, and not maybe sometimes don't ask only for a call, maybe say, let's go grab a coffee or a beer, together, and let's talk together face to face with another CEO and explain me what was your life, with these investors, and what happened, how present, they were, with you when things happen or stuff like that. Regular question, but you need to have this conversation. Don't pick an investor without doing that.
So we had CEOs.
Unless you have only one.
I had some CEOs ask me, should they actually hire someone to help them fund their fundraising, get their money?
I did that first with my first company because I didn't have any network. Okay. I didn't know anything about raising money with Blue Kiwi. I was coming from Limoges, avec mes sabots en pipaille, very countryside of France. I didn't know anything. I didn't have any network. In Paris, I didn't know what was an investor at this time, and I got help, by Angels Finance. That was a fundraiser. Well, I don't know how to do that. Yeah. And it was very necessary, for me, because I didn't know anything and dedicate myself. They were not, programmed like UBIO and stuff like that at this time. And now, Baze, I won't use them anymore.
I have a very strong view on that. I mean, it's very market specific, by the way, and stage specific. So, talking about early stage companies, first of all, in Europe, a very common practice, like what you did, right? So we see a huge number of deals brought to us in Europe through intermediaries. The point is that you are selling your company as an entrepreneur, right? It's no different than you're selling your product to Coca-Cola or IBM. If you can't find your way to the person you need to sell your product to, whatever company, you won't be able to succeed as an entrepreneur. So if you can't find your way to me, if you want to talk to me as an investor, through someone I know, or Stefan or Carlos or whatever, or someone like you, I probably don't want to talk to you. It's like, Darwinistic selection in a way, right? But I'm actually serious. Right? So I won't talk to an intermediary here.
And that's very right. Just to give you an example, for example, I know Nicolas. We know each other very well. I have his phone number. I have his email and stuff like that. I can make you an introduction, to Nicolas, of course. But I won't do it if you don't sell the company to me. And I'm not doing you a lot of introduction. Because some of the time, people, first of all, French people don't ask me for introduction to investors. That's crazy. I mean, a lot of the time they want to meet with me, we have cool conversation, we have lunch, whatever. But at the end, they don't ask me anything. Okay, so I'm like, if you don't ask me anything, that means that you don't need anything. So that's fine. So I'm not going to do an introduction to you. And now, if you ask me for an introduction, if I'm not sold, if you didn't sell me the company first, I won't make an introduction to Nicolas. Because my reputation to Nicolas is very important to me. It's an ecosystem here. So first of all, he's totally right. If I make him an introduction, that means that you sold the company to me first. And if you sold the company to me first, then I will sell your company to Nicolas first, and then you have to do your job again. But please, sell your company. Don't come to me, ask and to tell me what's the life in France. I know life in France. That's why I moved here. So, you know what I mean? And I have access to newspaper and stuff like that, so I know what's going on, and so if you come to visit me, and meet with me, tell me about your company. That's what I care about, And if your company is pretty exciting, then maybe I can make you some introduction. But it's going to be tough, of course. I am expecting you to sell the company, and I'm very surprised that most of the French people don't sell me anything. Well, they sell me themselves.
Yeah. On the intermediary thing, just one more comment. In Europe, it's okay to use them, because everybody does. Mm-hmm. But please, when you go to a meeting with a VC, do not let them talk. Okay? They're not the ones pitching. You are, right? It is extremely annoying for us when we ask questions to the entrepreneur and the banker answers. I'm not, and sometimes I have to be really rude to them. Like, please, can you not answer? I'm not investing in you. You're not going to be around next month. But it's manage that because it makes you look bad.
All right. Can we talk a little bit about valuation? 409A. I think it's critical.
Well, those are two separate things, right?
Correct.
409A is a technical thing it's an insurance policy. Sorry, I don't want to put it on for the board to enable to protect the board and the employees from any IRS sanction for having granted stock options at the wrong price. Right? We never did this until it became really required. And I'm not saying that that you guys are not doing real work to put those together. That's really not the point, right? But it is in the context of, from a venture capitalist point of view, or I think an entrepreneur.
Yeah, I was saying, I didn't get it, first.
You can also slow down an acquisition. If a public company is going to buy your company, an audit firm is going to come in, a significant audit firm is going to come in and look at how you valued your options. And if you didn't use the right methodology, it can slow up your acquisition.
So I have a company, for example, and it becomes really, it's just a very most annoying subject. It's a technicality. We shouldn't spend too much time on that. I don't think it affects you that much. But like I have a company in my portfolio, for example, that went from $14 million in revenue a year ago to 40 last year, doing very well. the 409A valuation came in this year lower than it did the year before, right? The company has spitting out cash, right? Why? Because some comps in the market and affected the Black-Scholes formula, something like that. Right? Makes no sense.
Yeah.
So, but people do it because we have to, not because we want to. It's good business for you guys.
Right. Well, it's a business reality.
No,
Yeah.
we need to comply with rules, and that's one of the rules. We have to.
Yeah.
I understand. Maybe it's for good reasons, and we have to do it. We do it, and I can.
So
it's a
did you
pretty
actually-
good company to do it with.
Actually explain a little
Yeah.
bit.
Did you actually want to talk about the valuation of stock options, or did you want to talk about pre-money valuation?
You could do both. Like,
Those
can
are
we start
separate
with
things,
498
Right.
and
So let's
explain
just
what it is?
since this is kind of what I do, I'll just give you the background on what a 409 is, why you have to worry about it. So the mechanism of a stock option is that it is not a share of stock. It can be converted into a share of stock. So that's the nature of the stock option. And it's converted into a share of option or a share of stock by exercising it. It's exercised by the holder of those options paying the strike price or the exercise price times the number of shares. So Nicolas had thrown out 100,000 shares at a strike price of 10 cents per share. That comes out to be $10,000. So if you have vested in that option so that you own it, you can exercise that option, convert it into common shares. The fact that it's convertible to common shares is very different than what this equity instrument is, which is a preferred share. There are all these preferences in preferred shares which distinguish it and give it greater rights than common shares. By virtue of these preferences, the common share is worth less on a fair market value than what the venture capitalist is paying on a per share basis to buy the preferred shares. As a for instance, if you're raising $1 million and issuing 1 million preferred shares, so that's $1 per share for the preferred shares. When someone comes in to value the fair market value of the common shares, it may come out at 20% of that $1 per share, or 20 cents per share. That 20 cents per share fair market value is then the strike price of the options that you are issuing to your new employees, which then means if you give somebody 50,000 options, it would cost them $10,000 to exercise those options and turn them into shares, which they would want to do only if there was a liquidity event. People do not exercise options until there's an acquisition that's imminent, or there's an IPO offering that's about to happen. That's when people will exercise their options, when they can take those shares and exchange them for a greater value. There you go.
It's very clear.
Now, very different from how we value the company, which has nothing to do with
Yes.
that, right?
Let's get into that. How do you do that?
There's
Where
no
do you start?
science.
How do you do that?
Where do you start?
I mean, there's no real science to it. It's a combination of factors. There's comps, the rest of the world out there. There is your bargaining position. Am I competing with 5 other VCs to invest in Carlos's company, or am I the only one? There is fund rationale, driving factors. So, we, as a venture investor, typically we want to own, between 15 and 25% of a company when we invest at Series A stage. Different funds have different kind of logic or objectives, so you need to understand what your investor's objective is in terms of ownership goal. You also need to understand what the investor's objective is in terms of capital deployment. So there's no point asking, Andres and Horowitz to invest, $2 million in your Series A copy. It's just not meaningful enough. So you need to try to understand, like Partech, for example. So as an example, in the early stage, we like to deploy up to $10, $12 in a company over stages. May I excuse myself for 1 second?
Yeah, I can take
Looks
over.
like I have an
Let me,
Carlos,
before Carlos
Yeah,
speaks
go
to
ahead.
it, let me just bring up a couple of concepts. So, pre-money valuation. That's important because this is before anybody puts any money into your company. That's what we're talking about. The concept of milestones. Have we talked about milestones as a group? Is that firmly understood? The thresholds that you as a company need to achieve to show that there's less risk that you're not going to be successful, which is what everyone wants to avoid, right? Everyone hopes that you're going to be successful. How do you define success as a company? Those are milestones. They may be product specific, or where is my business at in terms of meeting the needs of my customer base, whoever they happen to be. So now I have launched a beta of my product. That's a milestone. I brought my product to market through Kickstarter, some other milestone. That's a milestone. It could be on the marketing side, where I need to achieve a reseller arrangement because I've got a channel marketing approach to my product or service. So I've signed my first significant partnering agreement. It could be, if you're an enterprise sale, my first reference account or my first enterprise account. Because in an enterprise environment, that's a huge risk because the sales cycle for an enterprise sale is so significant. So, turning over back to Nicolas, the company-specific issues are important, what those milestones are. And those very often relate to the stages that you're going to raise money at. So you're going to want to raise enough money to hit a milestone so that the valuation of your company could be considered higher because there's a greater likelihood of success for your company. So
it kind of that's a good point. One of the things we think about is we like when we make a Series A investment to believe that the logical execution of the plan will drive to at least a 2x valuation increase on the following round. We like to have more, but that's if we don't believe that there's at least a 2x plan, it's very hard for us to rationalize, taking the risk of investing at a certain valuation because we end up paying the same price as the guys at the next round. So why take the risk? So it's a blurry answer. I think you're hearing, but it's really a bargaining and looking around. But typically you always end. It's funny because there's no hard rules, but interestingly enough, whenever we compete with other firms on the same deal, everybody kind of ends up in the same ballpark.
Yeah.
And you really should be focused on, the one or two key subjects that are the hot subjects for the company at that time. It's really a collaborative session, the way it should work or the way it works here, which is why it's really important to have people on the board that I use the dating marriage paradigm a lot when I talk about raising money and picking board members. It's really important to pick the right people that you can freely communicate, exchange with. We don't have huge egos on one hand, as they've done it all, they've seen it all, and they know better than anybody else. And then they have a complementary set of experiences that they can bring to the table. And it's also collaborative. Like almost every single board that I go to includes all the key executives, not just the key, not just the board members. Right? And that's an unusual thing sometimes in Europe. So
invite people to your board.
Yeah, invite the key execs. Not maybe depending on the size of the company. Not necessarily every exec is there every time.
And that's important in terms of management, so they understand that they're not board members. You invite them sometimes, but sometimes you don't invite them, so they understand that
they can be there for part of the meeting and not
right, exactly.
Some of the VP of marketing will prepare their section and their few slides, and maybe present them, and it's really important to have all these people around the table because that's how you have very interesting strategic discussions. It's really important to integrate everybody's perspective in it, and it also creates what I would say is mutual accountability. There's a great level of transparency that's forced to that process, as opposed to a CEO running the company and through monopoly of information, which is a very unhealthy way of building a company, but is the way that a lot of small companies run. And so you kind of break that mold by forcing this more open structure. And that's sometimes uncomfortable for an entrepreneurs who don't come from Silicon Valley. They are shocked that everybody sees how much cash the company has, what's the burn rate, how much we spend on this and that. But we think everybody should see that. Now, typically there's a executive session at the end of the board, which is maybe 15 minutes or half an hour to discuss really confidential or legal matters. But the core of the business is discussed as a group.
So the way I structure my board, just to give you an example, so I've got the first part is what I call board business. So it's really legal aspects, like stock option grant and stuff like that. So you have to give some stock options to people and stuff like that. So it's usually about 10 to 15 minutes. It's me and the board members, and it's really what I call board business. And the part two is really more financial, reporting and with very key elements. And what I used to do is I really send these elements, in advance, something like maybe 3 to 4 days, before the board, because I don't want really to comment that in detail. I say, okay, you got the financial elements, unless there is a very important point where we're raising money, or we need a bridge, or we need a whatever. Then it becomes a true important point to talk about. So I got these financial report and business update, with numbers, but they had these numbers first. And basically, I said, okay, you received the numbers. Do you want us to comment anything, on whatever you have used? And we have a conversation about that. It's not, there is no slide. I mean, look at the revenue, for example, the expenses.
So just to kind of reiterate what Nicolas and Carlos are both saying, which is really important, is the reason you're doing this is because you want to engage your board.
Yeah.
One of the reasons why you're here in the States is you're connecting, and one of the reasons why you're getting these VCs engaged with you is that they can do things for you. They can open up strategic relationships. When you talk about, what vertical are we going after, and who is the customer trying to get, or who's the strategic relationship, they have Rolodexes. They know people at these companies. And this is how they can get involved and help you out from a very strategic business perspective. They can do things for you. And you should come out of those board meetings with action items for them to help you with.
Yeah, that's the part three is really strategic matters. So it really depends. It could be a business, could be product, could be recruiting, whatever. It changes, every board, because we have a board every month.
And different venture capitalists have different aspects that they like to help people with.
Right.
Some people are really good at business development. Some people are really good with product placement strategies.
And part four is that's in the part three is where you invite people of your team. So if, for example, if there is a product technology matter, you maybe bring your VP product or VP technology or whatever for a conversation with the board and stuff like that. If it's more about marketing, you will bring your marketing guys, and we all talk about that, all together. And at the end, I've got a part that is very, very important that I insist in doing it. Sometimes VCs are very they're running late and like, okay, let's leave. No, I insist to have a CEO wrap up. Right? Only me, and as a CEO of the company with investors, like, okay, what did you think? What did you think of what we're doing? What should I focus on? And stuff like that, where you're really open. You're not driving anymore. You're looking for feedback, and you also asking, for stuff for them to do stuff. Keep your board members busy.
Yeah, and then actually the other thing I will say is don't limit your interaction with the board to the board meeting.
Yeah.
The way investors work here is, we want to partner with the companies we invest in. I invest in one, maybe maximum 2 companies in a year on the venture side. That's the average of a VC. So my interaction, I pick people I want to work with that I like, who pick me because they like me for whatever reason. But it's a very, I don't expect to arrive at a board meeting and make all these discoveries. It's kind of a constant interaction. When my CEO called me last Friday, say, hey, can we get together for breakfast tomorrow? I want some ideas. I want to bounce off you. That, these kinds of interaction. Can you come over and meet so and so? And you should proactively engage your board beyond the board meeting for whatever they could help with.
I
No
think
surprises.
when you pick your investor, and it's not only about an investor, it's about a partner that you're going to work with. One of the questions in the due diligence you should ask is how many companies is involved with. You know, I mean, how many board seats does he have? You know, because I didn't do that. You know, and I had a board member that had something like 16 board seats. And by the way, these board members I never see him. You know, I mean, and when I ask him for, and I'm asking him a lot of times for, hey, do you have time for lunch or whatever? And by the way, he's downtown San Francisco, so we're just 2 blocks away. And most of the time he doesn't have time for that, you know, because he's super busy. I mean, that's 16 board seats. I mean, it's just crazy. So I think that's an important point. You need people that are available, you know, for you. And so I think that yes, I mean that someone who has more than 10 board seats is red flag. Unless you don't need them. You know, you just need
late
money.
stage is different, right?
Yeah, it depends on the stage of the company.
Or angel stage too, but they're not
Right.
typically on the board. So.
Yeah, and also at the same time, to take other side of the table, you don't want also a board member that is too overwhelming. I mean, and it happens. So how do you deal with that? Give them work to do. Sometimes I give them work to do that I don't need, but just to keep them busy. So when they call me and say, oh, what about, you know, I said, yeah, and what about what I asked you, you know, last week, you know, about, you know, oh yes, I'm working on it. Okay, so fine. So you refocus them on. So give them something, give them a hole, you know, to dig, you know, and a bone, you know, to whatever, you know. And no, but that's a tip, you know, I use, you know, sometimes when they become too crunchy or when they ask, you know, too much. Even,
So do you think you picked the wrong person, or you didn't do enough due diligence, or what did you learn from that?
yes, I think that maybe, you know, sometimes, not always. You know,
I mean, you don't always have a choice. Sometimes you
Yeah.
just need money, right?
That was another point. You know. I got 2 different board members, you know, right now. I've got one that is very present and another one that is not, you know. And now, after you need to find a balance and you need to work, you know, with I mean, the perfect, it's like a family, you know. I mean, there is not perfect family, you know. So we're not in a kinder, you know the kinder commercial where everybody's, you know, brushed, you know, correctly, you know, and everybody's super clean. That doesn't exist, you know. I mean, it's people, you know. I mean, so sometimes and it depends on the day, you know. I mean, sometimes they're good, you know, and sometimes they're cool. Sometimes, you know, maybe they got an argument with their wife, you know, or whatever, and you're like, what happened, you know? And it's so you don't know. It's about dealing with people.